Hey, I keep hearing people talk about owner financing homes in the US, but honestly, I have no idea what that even means. Is it like buying a house without a bank?
Pretty much, yes. Owner financing is when the seller acts as the bank. Instead of you getting a traditional mortgage from a lender, the homeowner gives you the loan directly to buy the house.
Wait, so the seller actually lets you pay them little by little? How does that even work?
Exactly. You and the seller agree on a few key things: the price of the house, the down payment, usually 5 to 20%, the interest rate, the monthly payment amount, and the loan term, like 3, 5, or 30 years. Once everything is set, you sign a contract, usually a promissory note and a purchase agreement. And then you start making monthly payments directly to the owner, not to a bank.
That sounds kind of amazing. So who actually chooses this option? People who can't get approved by banks?
Exactly. It's great for buyers with low credit scores, self-employed people who can't show stable income, anyone who needs flexible terms, buyers who want to skip strict bank requirements or avoid high closing costs. Plus, approvals are way faster. No underwriting, no waiting weeks for bank approval.
Okay, but what's in it for the seller? Why would someone offer owner financing?
Great question. Sellers benefit too. They can sell faster, especially if the home isn't bank-friendly. They earn interest every month, sometimes 6 to 10%. They attract more buyers. And if the buyer stops paying, they can take the home back depending on state laws. It's like earning monthly income plus potentially getting the house back, so sellers often like that.
Sounds too good. There must be some risks, right?
Of course, for buyers, interest rates are usually higher than banks. You need to trust that the contract is written clearly. If the seller still has a mortgage, things get tricky if they don't pay it. And in some states, the seller can evict you faster than a traditional foreclosure if you default. For sellers, if the buyer doesn't pay on time, it becomes a hassle. They need to follow state-specific laws for owner financing. They can't access all the money at once like a regular sale. This is why using a real estate attorney or a professional escrow company is super important in the US.
So if I wanted to buy using owner financing, do I still get the house in my name immediately?
Depends on the structure. There are two common types. Promissory note with deed of trust or mortgage, you get the title at closing and the seller holds a lien. Or contract for deed or land contract. You don't get the title until you finish paying. This one is riskier for buyers. Most buyers prefer the first option because it offers more protection.
Okay, that actually clears up a lot. So basically, owner financing is a private deal between the buyer and seller with flexible terms, no bank headaches, but still needs a solid contract and some caution.
Exactly. It's a great alternative for the right situation, especially for buyers who can't qualify for traditional mortgages or sellers who want predictable monthly income.